If you're thinking about buying a Volkswagen, or if you work in the automotive industry, or if you're invested in German manufacturing, what just happened at Volkswagen in 2026 directly affects you. The company is undergoing the largest restructuring in its entire 89-year history. Operating profits have collapsed by half. Stock prices have plummeted to their lowest in 16 years. And management is fighting with unions over what comes next. Here's everything you need to know. For nearly a century, Volkswagen has been the crown jewel of German engineering. The company that emerged from post-war Germany and built itself into one of the world's largest automakers is now facing an existential crisis that threatens to reshape the entire organization from the ground up. The numbers tell a story of catastrophic decline that would have been unimaginable just a few years ago. In 2025 alone, Volkswagen Group's net profit collapsed by 44% to 6.9 billion euros. That's the worst result since the diesel emissions scandal nearly a decade ago. The company's operating profit more than halved between 2021 and 2025. At one point in 2025, the operating margin dropped to just 2.8%. For a company of Volkswagen's size and historical profitability, numbers like that represent a complete breakdown of the business model that has sustained the organization for generations. But the real story becomes even more concerning when you look at the details. Volkswagen's shares have lost over a quarter of their value in 2026 alone. The stock has fallen to its lowest level in 16 years, a signal that investors have lost confidence in the company's ability to navigate the challenges it faces. This isn't a minor setback or a cyclical downturn that the company will weather and recover from. This is a structural reckoning that threatens the very foundation of German automotive success. The company is now forced to make decisions so dramatic that they would have seemed impossible just a year or two ago. Let me take you back to July 9th, 2026. That's when CEO Oliver Blume presented a restructuring plan to the company's supervisory board that shocked everyone involved. The plan was internally called the Group Target Picture, and it represented nothing less than a complete transformation of Volkswagen. The proposal included closing 4 German factories, eliminating up to 100,000 jobs across the Volkswagen Group by 2030, slashing the model lineup by up to 50%, and reducing global production capacity by roughly 1 million vehicles annually. To put this in perspective, these 4 factories alone employ more than 45,000 workers. The sites targeted for closure were Hanover, Zwickau, and Emden, along with Audi's facility in Neckarsulm. The economic impact on these communities would be devastating. When news of these proposals leaked before the official board meeting on July 4th, it sent shockwaves through Germany that reverberated through every community with a Volkswagen facility. Labor representatives, who hold significant power within Volkswagen's complex supervisory board structure thanks to German corporate governance laws, mobilized immediately to organize opposition to the restructuring proposals. Union leaders held emergency meetings. Workers began preparing for potential strikes. Community leaders in towns like Neckarsulm and Zwickau mobilized to make their voices heard. When the board met on July 9th to vote on the restructuring plan, the tension was palpable. Management presented detailed analyses of why the company needed such drastic restructuring. CFO Arno Antlitz explained that current cost structures were unsustainable in the competitive environment. Labor representatives listened, but ultimately rejected the most aggressive proposals. The Labor bloc voted against the plan, with the margin being decisive, 12 votes to 7 against the proposal. Volkswagen's management had expected to push through a sweeping restructuring given the dire financial situation, but instead they were blocked by the very workers whose jobs were at stake. The message was crystal clear. Volkswagen's workforce would not go quietly into massive layoffs and factory closures. They would fight for their jobs, their communities, and their dignity. The struggle between management and labor represents one of the most important stories about corporate governance and worker power in modern times. Germany has a unique system where workers have representation on corporate boards. At Volkswagen, the state of Lower Saxony holds a 20% stake in the company, and both the state and labor unions have significant board representation. This structure, which was put in place to protect workers and ensure they have a voice in major corporate decisions, became the bulwark against management's most aggressive proposals. Even with the labor board's rejection of the full package, Volkswagen still announced major restructuring measures. The company said the model lineup would be gradually cut by up to 50%. Production capacity would be reduced to 9 million vehicles per year, compared to a goal of 12 million before the coronavirus pandemic. But the factory closures and the full scale of job cuts remain contentious and unresolved. To understand how Volkswagen arrived at this crisis point, we need to examine the multiple pressures that have converged to create a perfect storm of challenges. The first and most significant pressure is China. For decades, China was Volkswagen's primary profit engine. The company had built massive joint ventures with Chinese state-owned enterprises. It was the top foreign automaker in the country, but that dominance has evaporated almost overnight. In the first quarter of 2026, Volkswagen sales in China dropped 14.8% compared to the same quarter in 2025. In the second quarter of 2026, the decline was even more dramatic. Volkswagen sales in China plunged by 36.6% in that single quarter alone. The company went from being the market leader to dropping to third place as Chinese manufacturers like Geely and BYD captured market share with cheaper, tech-heavy vehicles. The challenge in China is multifaceted and deeply structural. BYD, the Chinese EV manufacturer, has been aggressively expanding its lineup and cutting prices in ways that are reshaping the entire automotive landscape. The company is producing electric vehicles that appeal to Chinese consumers at price points that Volkswagen simply cannot match while maintaining profitability. BYD was unseated as China's top automaker in early 2026, falling to fourth place. But that's temporary. The company continues to have technological advantages and cost structures that allow it to undercut international competitors. Volkswagen's traditional internal combustion engine vehicles are seen as outdated by Chinese buyers who want modern electric vehicles with advanced technology features. The company's electric vehicle offerings, primarily the ID series, have not sold as well as hoped. Chinese consumers are increasingly moving toward vehicles built by domestics, manufacturers that offer better technology integration, faster charging capabilities, and vehicles specifically designed for Chinese preferences and road conditions. Companies like BYD have the advantage of understanding local preferences intimately, having dramatically lower labor costs compared to German manufacturing, and being able to move quickly in response to market trends. They can develop new models faster, iterate based on customer feedback rapidly, and adjust pricing strategies without the bureaucratic constraints that affect Volkswagen. The Chinese market represents a fundamental shift in competitive dynamics that Volkswagen is struggling to address despite its best efforts with partnerships like XPeng. First quarter 2026. Earnings data underscored the depth of Volkswagen's pressure in China. Net profit shrank by 28% year-on-year to 1.56 billion euros, and revenue edged down 2% to 75.7 billion euros. These aren't the numbers of a company experiencing temporary challenges. These are the numbers of a company whose fundamental position in one of the world's most important markets is collapsing. When you couple China's decline with declining sales in North America and stagnant growth in Europe, the picture becomes even more dire. The second major pressure facing Volkswagen is United States tariffs. The Trump administration's trade policies have created a new cost structure that Volkswagen simply wasn't prepared for, and that fundamentally changes the calculation of global manufacturing strategy. CFO Arno Antlitz has put the annual cost of U.S. tariffs at roughly 4 billion euros, a figure that represents a massive structural headwind to profitability. That's not a minor adjustment to the business model that can be absorbed through efficiency improvements. That's a structural cost increase that eats directly into profitability and makes large portions of current business planning irrelevant. In the first quarter of 2026, deliveries in the United States dropped by 20.5%. A significant decline that was partially due to tariff-driven pricing increases that made vehicles more expensive for American consumers. Electric vehicles were hit even harder than traditional vehicles, as tariffs compounded the already challenging economics of EV production. Tariffs are making it harder to import vehicles into the United States, creating a situation where Volkswagen must choose between accepting lower profitability or investing heavily in American manufacturing capacity. The company is changing the economics of producing vehicles for the American market in ways that require fundamentally rethinking where and how vehicles are built. But the tariff problem goes beyond just the direct costs of importing vehicles. Tariffs create broader economic uncertainty. They make planning difficult. They shift the calculation of where to manufacture vehicles and which markets are viable. For Volkswagen, which has historically built vehicles in Germany and exported them, globally, tariffs represent a direct threat to its business model. The company is now facing pressure to manufacture more vehicles in the United States to avoid tariffs, but that requires capital investment in new factories and dealing with much higher American labor costs. It's a no-win situation that contributes to the company's overall profitability crisis. The third major pressure is Volkswagen's failed strategy at Porsche. Porsche is supposed to be the profit powerhouse of the Volkswagen Group. It's a luxury brand with high margins and a devoted customer base. In 2024, Porsche generated 5.3 billion euros in operating profit. That was a significant portion of the Volkswagen Group's overall profitability. But in 2025, Porsche's operating profit collapsed by 98%, falling to just 90 million euros. The automotive division alone saw operating profit nearly disappear. What happened? Porsche decided to pursue an aggressive electric vehicle strategy. The company committed billions of euros to developing electric vehicles, believing that wealthy customers would embrace the technology. But the strategy didn't work as expected, and the reasons reveal important lessons about how global markets are changing. Demand for high-end electric performance cars didn't grow as quickly as anticipated. Wealthy customers who can afford Porsche's premium pricing were hesitant to embrace electric vehicles, concerned about charging infrastructure, range limitations, and the relative immaturity of EV technology at the highest performance levels. Chinese competition affected Porsche's sales in its most important markets. Porsche deliveries in China dropped 26%, a steep decline in what had been a crucial growth market where the company had generated significant profits for years. Global deliveries dropped 10% during the year, signaling weakness across multiple markets and customer segments. The company's strategy of betting heavily on electrification while simultaneously trying to maintain premium pricing turned out to be a losing combination. Wealthy customers weren't ready. Market conditions were changing faster than anticipated. Competition was intensifying. The company was forced to reverse course in a dramatic fashion. Instead of continuing its aggressive EV push, Porsche pivoted back toward combustion engine vehicles, particularly high-performance models that could command premium pricing and maintain margins. That reversal carried a massive financial cost. Porsche booked extraordinary expenses totaling approximately 3.9 billion euros in 2025. About 2.4 billion euros of those charges were linked to the shift away from the ambitious electric vehicle program. Another 700 million euros related to battery activities, and 700 million more related to the impact of U.S. tariffs. These write-downs essentially wiped out Porsche's profitability for the year. What was supposed to be a strategic repositioning became a financial catastrophe. For a company that was once considered one of the most profitable in the Volkswagen Group, the scale of the hit shocked investors. Porsche was removed from Germany's top-tier DAX index after its stock lost more than 30% of its value. The company that symbolized German luxury and engineering excellence was now mired in a profitability crisis. The fourth pressure is structural costs in Germany. Volkswagen operates some of the most expensive factories in the world. German labor agreements provide workers with strong protections, job security, and high wages. These collective bargaining agreements were negotiated over decades and reflect the power of German labor unions. They're important for worker well-being and social stability, but they also create a cost structure that makes it difficult for Volkswagen to compete globally. When Chinese manufacturers can produce vehicles at a fraction of the cost, and when American competitors have lower labor costs, Volkswagen's German factories become a competitive disadvantage. Adding up all these pressures, the numbers become clear. Operating margins that once reached double digits have collapsed to single digits. The company that was generating 8.9 billion euros in operating profit in 2024 saw that number halve to 4.4 billion in 2025. The CFO stated directly that an operating margin of 4.6% adjusted for restructuring is not sufficient in the long run. Volkswagen would need to continue rigorously reducing costs. The company was already in the process of cutting 50,000 jobs by 2030 under an agreement reached with unions in late 2024. But management recognized that 50,000 job cuts would not be enough. They believed 100,000 job cuts would be necessary to restore competitiveness. What's particularly infuriating to Volkswagen's workers is that even as profits have collapsed and the company is planning massive layoffs, executive compensation has not declined proportionately. Despite the group's worst results in nearly a decade, members of the Volkswagen executive board continue to receive bonuses totaling millions of euros. CEO Oliver Blume received total remuneration of around 7.4 million euros, which was slightly less than the previous year thanks to a voluntary pay waiver that was likely implemented to manage public relations. But the management board's total bonus payments came to around 13.6 million euros, a staggering figure driven largely by net cash flow, which hit 6.4 billion euros, the highest target level in the remuneration system. The disconnect is jarring. The company is losing money hand over fist on operating activities, but it still has massive cash flow because it's reducing investments and cutting expenses. Executives are being rewarded for that cash generation, even as workers face job losses. This created enormous anger among workers and their representatives. How could the company justify cutting 100,000 jobs while paying tens of millions to executives? The hypocrisy was evident to everyone. Employee representatives began demanding that the workforce share in the strong cash flow in the form of special payments and wage increases to offset the uncertainty and pain of restructuring. The tension between labor and management reached a fever pitch. The geographic and social implications of Volkswagen's crisis are profound. The 4 plants slated for closure in the restructuring proposal are in communities that depend heavily on Volkswagen for employment and economic stability. Neckarsulm, home to Audi manufacturing, became the focal point of these concerns. Local residents expressed devastating concerns about the impact on their lives. One local resident, Harry Leinmiller, told the New York Times that there are so many young people here. Some have bought building plots in the countryside. Many won't be able to pay for their houses anymore. These aren't abstract economic statistics. These are real people whose entire lives and futures depend on Volkswagen plants remaining open and operating. The political response to Volkswagen's crisis was swift and intense. Both far-right and far-left political parties protested the restructuring plans. In Neckarsulm, members of the Marxist-Leninist Party of Germany were passing out flyers urging workers to participate in preemptive strikes against any closures. Such strikes are technically illegal in Germany, but the level of desperation was evident. The German government itself weighed in, with government spokesperson Stefan Cornelius stating at a news conference that the ultimate goal of the government is to preserve the locations. The German government has a vested interest in protecting manufacturing jobs and industrial capacity. Volkswagen's troubles have become a matter of national importance. The complexity of Volkswagen's board structure has become both a protection for workers and an obstacle to the swift restructuring that management believes is necessary. Volkswagen's supervisory board structure is unlike most American corporations. German law requires that workers have representation on corporate boards. This gives labor unions real power in corporate decision-making. At Volkswagen, the labor bloc on the supervisory board blocked the most aggressive restructuring proposals. But this same complex structure also makes it difficult for management to move quickly. Every major decision must navigate the interests and concerns of multiple stakeholders. This is arguably more democratic and more protective of workers, but it also slows down corporate transformation when transformation seems necessary for survival. Analysts are divided on what happens next. Jefferies analysts said there was no indication of progress towards an agreement having been reached on factory closures or large-scale job cuts. Bernstein analysts described Volkswagen's announced strategy as long on ideals but very short on specifics. Some observers believe that Volkswagen will eventually find a middle path between management's aggressive restructuring and labor's resistance. Others worry that the company is in a slow-motion crisis, unable to move fast enough to address its competitive challenges. The sentiment among analysts is clear. Something needs to happen, and it needs to happen soon. Volkswagen announced a 4-year plan aimed at improving competitiveness, but many of the most critical elements remain unresolved. The company plans to reorganize its corporate hierarchy, with core brand and component divisions expected to operate more independently, fostering agility and reducing bureaucratic overhead. This structural overhaul aims to enhance shareholder value and attract investment by creating a more flexible and transparent corporate model. The company is also pursuing an in China for China strategy, focusing on local development and local supply chains with Chinese partners like Xpeng. The company is developing its first model co-developed with Xpeng and planning to launch more than 20 new electric vehicle models in China in 2026 alone. Despite these efforts, and despite management's confidence in strategic initiatives, the company remains deeply cautious about its future. The numbers speak volumes about the challenge ahead. Volkswagen expects an operating margin of between 4 and 5.5% in 2026, after 2.8% in 2025 and 5.9% in 2024. That's barely half the margin the company was generating just 2 years ago. Revenue is expected to develop in a range of 0 to 3%, signaling absolutely no expectations for growth in sales volume. The company is not expecting to sell more vehicles. It's hoping just to maintain current sales levels while trying to improve profitability through cost-cutting and efficiency. The company's long-term goal is to restore operating margins to 8 to 10% by 2030. That's an ambitious target that will require success on multiple fronts simultaneously. The company needs to successfully navigate the Chinese market and stabilize market share there against intense competition from BYD and other Chinese manufacturers. It needs to adapt to American tariffs through either restructuring its supply chains or investing in American manufacturing. It needs to restore profitability at Porsche through a combination of cost reduction and successful new model launches. And perhaps most critically, it needs to manage a massive restructuring without alienating its workforce or losing critical institutional knowledge. That's a lot to accomplish simultaneously while operating under extreme financial pressure. For workers in affected communities, the uncertainty is absolutely devastating and existentially threatening. They don't know if their factories will close. They don't know if they'll still have jobs in a year or 2 years or 5 years. Many workers have made life decisions based on the assumption of stable Volkswagen employment. They've bought homes, started families, made long-term financial commitments. Now all of that is in jeopardy. Volkswagen agreed a deal with unions in late 2024 to avoid factory closures in Germany and rule out compulsory redundancies until the end of 2030. But that agreement now seems increasingly fragile and vulnerable to being abandoned. Management has signaled clearly that it wants to break that agreement and pursue more aggressive restructuring than the deal allows. Negotiations between management and labor representatives will likely be contentious and protracted. with management pushing hard for concessions and labor resisting as fiercely as possible. The vehicle is being prepared for unsupervised robotaxi operations. But here's the critical problem. The Cybercab cannot legally operate as an unsupervised autonomous vehicle in most jurisdictions yet. Regulators are not moving at the pace that Tesla needs. Waymo is operating limited robotaxi services in specific markets because Waymo has been transparent with regulators, worked through the approval process methodically, and earned permission market by market. Tesla's approach has been more aggressive and less collaborative. The result is that Tesla's robotaxi fleet cannot deploy at scale yet, regardless of how many Cybercabs roll off the production line at Giga Texas. This regulatory reality is crucial because it exposes a fundamental mismatch in Tesla's business narrative that hasn't been adequately discussed in financial media. The company wants the valuation logic of a software and AI company while carrying the operating burden of a manufacturer. Software companies scale without friction. They don't require regulatory approval to expand into new markets. They don't have to worry about civil liability when their products fail. They don't face the scrutiny of federal safety agencies or congressional oversight. Tesla is trying to be both at once. It wants to be valued like NVIDIA or OpenAI because of its AI capabilities and software potential. But it's structured like Ford or General Motors because it builds physical vehicles that operate in public space under safety law, media attention, constant regulatory scrutiny, and civil liability. That tension sits at the center of Tesla's current challenges. Every quarter, Tesla promises that full autonomy is coming. Every quarter, regulators move slower than Tesla's timelines would suggest. Every quarter, the gap between promise and reality grows wider. That gap is not temporary, it's structural. The company has invested billions into autonomous driving and AI infrastructure. It has built massive Dojo supercomputer clusters. It has collected billions of miles of real-world driving data. It has trained neural networks to interpret that data. None of it matters if regulators don't approve unsupervised robotaxi operations. And regulators are moving slowly, much more slowly than Musk's timelines would suggest. Full self-driving supervised, Tesla's more limited autonomous offering, has expanded significantly in 2025 and 2026. The company expanded access to Australia, China, New Zealand, and South Korea in 2025, with Belgium, Denmark, Estonia, Lithuania, and the Netherlands following into 2026. The rollout pace tracks with what regulators have been saying on the ground. Norway has already laid out its next steps following the Netherlands RDW approval. The safety data is compelling. But here's the catch. Full self-driving supervised is not the same as full autonomy. It still requires driver supervision. It's enhanced driver assistance, not autonomous robotaxi technology. Tesla has sampled 65 million miles of real-world driving in 2025 and found that FSD-engaged trips used 5% less energy than the same distance driven manually, with the efficiency gain peaking in the 25-55 mph range, typical of city and suburban driving. That's a meaningful optimization, but it's not the robotaxi revolution. It's not the product that justifies Tesla's current valuation multiples. It's just a better version of what Audi and Mercedes and BMW already offer. The Cybercab, by contrast, is supposed to be different. With full autonomy and maximized ride-hailing, Tesla projects that Cybercab will avoid nearly twice the greenhouse gas emissions per mile of a Model 3 or Model Y. That's a compelling environmental narrative, but it doesn't matter if the vehicles can't be deployed. It doesn't matter if they're stacked up at Giga Texas waiting for regulatory approval. The manufacturing scaling that Lars Morvey was probably hinting at is real. The production capability is there. The infrastructure is there. The supply chains are there. But the regulatory framework isn't there yet. And that's the constraint that nobody wants to discuss publicly. Let's zoom out and look at the broader market context. The global EV passenger vehicle fleet is forecast to grow from under 100 million in 2026 to approximately 1 billion by 2050. That's exponential growth. It's the defining story of transportation infrastructure over the next 2 decades. But in the medium term, growth is uneven and increasingly unpredictable. Global EV sales increased by 25% in 2024 to 17.8 million units, with projected 23.7 million sales in 2025, and growth continuing through 2026. The market share of EVs in the light vehicle market reached 19.9% in 2024, and is expected to hit 25.5% in 2025 and 27.5% in 2026. Those are solid growth numbers, but they obscure regional disparities and the category fragmentation happening beneath the surface. China is projected to account for 61% of the total EV installed base in 2026. China is growing aggressively. Europe is growing through regulatory mandate. The United Kingdom just saw EV sales overtake petrol car sales for the first time, which is a meaningful milestone. But the United States is stagnating because consumers are choosing hybrids. Consumers are making a rational economic decision. That's the story that matters most because it directly impacts Tesla's market opportunity. In the United States specifically, car buyers have pulled back from fully electric vehicles and are embracing hybrids, according to Dan Hirsch, managing director at Alex Partners. The reason is straightforward. Americans have a huge country and people live far away from each other compared to Europe, where charging infrastructure is better and people don't have to drive quite as far. A hybrid vehicle gives American consumers the best of both worlds. Electric capability for short daily commutes and gas backup for long road trips, without the range anxiety or charging infrastructure anxiety that comes with pure EVs. The decision to buy a hybrid is rational given current infrastructure. Tesla's entire business model is predicated on consumers abandoning that rational choice and embracing pure electric vehicles. But the market is saying no. The market is choosing differently. And that's not a temporary phenomenon. That's a structural shift. Oil prices have also played a role. Trump's war with Iran drove up gasoline prices in early 2026, which temporarily boosted EV sales in Europe. But as a fragile truce between the United States and Iran took hold and diplomatic efforts began to stabilize the region, oil prices returned to pre-conflict levels. The temporary boost to EV sales faded, gasoline became cheaper again. The incentive to buy an EV diminished. This is another constraint on Tesla's growth that's largely external to the company's control. Cheaper gas means weaker EV demand. That's just how market dynamics work. And unless there's another geopolitical supply disruption, oil prices are likely to remain relatively stable going forward. Let's return to the fundamental disconnect that started this analysis. Tesla beat delivery expectations by a significant margin, but the stock fell sharply anyway. Analysts were expecting 406,600 deliveries. Tesla delivered 480,126.